Hey, what's up everybody? It's finance made easy now. Here's something that might surprise you. Did you know that dividends have accounted for over 40% of the total stock market returns in the last century? According to a recent study by Hartford Funds, if you invested $10,000 in the S&P 500 in 1960, without dividends you'd have $627,000 today. But with dividends reinvested, that same $10,000 would be worth over $3.8 million. Today, I'm going to show you exactly how to build a dividend portfolio that can generate passive income for life. Stay until the end, because I'll reveal 3 dividend investing strategies that most financial advisors won't tell you about, plus the exact stocks I would buy if I were starting a dividend portfolio from scratch in 2025. Before we dive into specific strategies, let's understand what makes dividend investing such a powerful wealth-building tool, especially in today's market. According to BlackRock's latest research, companies that consistently pay and grow their dividends have outperformed non-dividend payers by an average of 2.1% annually over the past 30 years. What's even more interesting is that these companies typically show 25% less volatility in their stock price. Think of dividend investing like planting a money tree. The tree, your initial investment, grows over time, capital appreciation, but it also produces fruit, dividends, that you can either eat, take as income, or use to plant more trees, reinvest. The key is choosing the right trees and maintaining your grove properly. Let's explore the 4 main categories of dividend stocks that you can use to build a strong dividend portfolio. Each of these categories serves a unique purpose in creating a balanced income-generating strategy. The first category consists of dividend aristocrats. These are well-established companies that have increased their dividends for at least 25 consecutive years. Companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola fall into this category. Dividend aristocrats typically provide yields between 2% and 4%, with annual dividend growth ranging from 5% to 10%. These companies offer exceptional stability and lower risk compared to other dividend-paying stocks. The second category encompasses high-yield dividend stocks. This group includes real estate investment trusts, REITs, master limited partnerships, MLPs, and certain utility companies. These investments typically offer yields ranging from 4% to 12%. While they provide higher current income, they also come with increased risk and limited growth potential. Investors need to carefully consider the tax implications when investing in these securities. Dividend growth stocks form our third category. These are relatively younger companies that have established dividend programs with rapid growth potential. Many technology companies fall into this group. While their current yields might be modest, ranging from 1% to 3%, they often increase their dividends by 10% to 20% annually. These stocks also offer strong potential for capital appreciation. The fourth category consists of international dividend payers. These companies offer geographical diversification and often provide higher yields than their U.S. counterparts. European dividend stocks currently average yields of 3.5%, while emerging market dividends can exceed 5%. These investments provide currency diversification benefits, but come with their own set of tax considerations and risks. Now let's walk through a comprehensive framework for building a dividend portfolio that can generate sustainable passive income. This framework divides your portfolio into 4 strategic components, each serving a specific purpose in your income-generating strategy. Your portfolio's foundation should start with core holdings, which should represent approximately 40% of your total investment. These core holdings should consist of dividend aristocrats selected from different sectors of the economy. You should aim for an average yield of 3% from these holdings, choosing companies with proven track records of dividend growth spanning more than 25 years. The next portion of your portfolio should focus on growth, representing about 30% of your investments. These holdings should include companies demonstrating dividend growth rates of 10% or higher annually. You should look for businesses with strong earnings growth and conservative payout ratios below 50%. Companies like Microsoft, Apple, and Visa exemplify this category. For your portfolio's high-yield component, which should make up roughly 20% of your investments, you should focus on selective high-yield stocks, including carefully chosen REITs and utilities. When selecting these investments, you should concentrate on companies maintaining sustainable payout ratios. It's crucial to thoroughly research any stock yielding more than 8% to ensure the dividend is sustainable. The final 10% of your portfolio should be allocated to international dividend payers. You can achieve this exposure through carefully selected ETFs that focus on dividend-paying companies in developed markets. When investing internationally, you should consider whether currency hedging makes sense for your situation, as currency fluctuations can impact your returns. Let me share 3 advanced strategies that most financial advisors won't tell you about, but that can significantly enhance your dividend investing returns. The first strategy involves dividend capture trading. This approach requires you to purchase stocks shortly before their ex-dividend date and sell them after capturing the dividend. While this strategy demands more active management than traditional dividend investing, it can potentially increase your annual yield by 1 to 2 percentage points. You'll need to carefully consider trading costs and tax implications when implementing this strategy. Our second advanced strategy focuses on options enhancement. By selling covered calls against your dividend-paying stocks, you can generate additional income of 2 to 5% annually, while simultaneously reducing your portfolio risk. This strategy works particularly well with stable, low-volatility dividend stocks that have active options markets. The key is to select strike prices that allow you to maintain your positions while collecting both dividends and option premiums. The third strategy implements dividend laddering, which operates similarly to bond laddering, but with dividend stocks. You'll want to carefully select stocks with different payment dates to ensure you receive dividend payments every month of the year. This approach helps smooth out your cash flow and reduces income volatility, making it especially valuable for investors who rely on their portfolio for regular income. Every successful dividend investor needs to understand and avoid 3 critical mistakes that can derail their income-generating strategy. Let me explain each of these pitfalls in detail. The first major mistake involves falling into yield traps. Many investors make the error of chasing unusually high dividend yields without investigating why these yields are so high. You need to carefully examine a company's payout ratio and dividend growth history before investing. A sustainable dividend typically comes from a company with a payout ratio below 75% and a history of consistent dividend growth. The second common mistake relates to poor diversification. Many dividend investors concentrate too heavily in traditional dividend-paying sectors like utilities and consumer staples. You should spread your investments across multiple sectors and geographical regions to reduce risk. This includes maintaining exposure to international dividend-paying stocks and considering total return potential alongside dividend yield. The third crucial mistake involves tax inefficiency. Many investors fail to optimize the tax treatment of their dividend investments. You should hold your highest yielding investments in tax-advantaged accounts whenever possible. Additionally, you need to understand the distinction between qualified and non-qualified dividends, as this can significantly impact your after-tax returns. Remember, successful dividend investing isn't about finding the highest yields. It's about building a sustainable income stream that grows over time. Whether you're starting with $100 or $100,000, the key is to begin now and reinvest those dividends consistently. Let me outline your action plan for getting started. First, you should open a brokerage account with a reputable firm that offers dividend reinvestment programs. Next, you should begin by investing in 2 or 3 well-established dividend aristocrats. Make sure to set up automatic dividend reinvestment for all your positions. Then you should add 1 new position to your portfolio each month as your capital allows. Finally, you need to review and rebalance your portfolio quarterly to maintain your target allocations. If you found this video helpful, hit that subscribe button and notification bell to stay updated on more wealth building strategies. Drop a comment below sharing your favorite dividend stock, and I'll personally respond with my thoughts. Thanks for watching, and until next time, keep crushing your financial goals.